Did you know that investing in dividend ETFs can give you a steady stream of passive income, even in uncertain markets? Some of the best dividend ETFs consistently pay out yields that crush the market average, essentially turning your portfolio into a paycheck machine. But here's the challenge. In today's market, volatility has become the new normal. Inflation, rising rates, and global uncertainty leave many investors asking the same question: where can I actually find stability? Savings accounts barely keep up with inflation, and chasing individual dividend stocks often comes with dividend cuts or unexpected risks. That's exactly why dividend ETFs are gaining so much traction. They offer instant diversification, reliable payouts, and far less stress than managing dozens of single stocks on your own. And in this video, I'm going to break down the top 3 dividend ETFs built for buy and hold investors. If you're planning for retirement, building long-term wealth, or just love the idea of weekly or monthly cash flow while you sleep, these ETFs could help you get there. Don't worry, I'll break down each of the top 3 dividend ETFs, highlighting their recent performance, dividend yields, and the sectors they focus on. You'll see how these ETFs balance risk and reward, why they've become favorites among passive income investors, and how they can fit into your long-term portfolio strategy. By the end, you'll know exactly which dividend ETFs deserve a spot on your watch list. If you enjoy this kind of content, don't forget to like, share, and subscribe. It helps us reach more investors like you. Quick reminder, this video is not financial advice. Investing in stocks is risky. Always do your research before making any decision. All right, let's begin. First on the list is YieldMax MSTR Option Income Strategy ETF, ticker symbol MSTY, a fund that's been making serious noise in the dividend ETF world. Unlike traditional income funds that rely on dividends from companies, MSTY uses a covered call strategy on MicroStrategy, MSTR, the company that's become practically a proxy for Bitcoin because of its massive crypto holdings. What this ETF does is take MSTR's extreme price volatility and turn it into option premiums, which are then paid back to investors as distributions. And here's where it gets eye-popping. Over the last 12 months, MSTY has handed out around $26.07 per share, which equals a jaw-dropping 169% annualized yield. That's not just high, it's in a league of its own. For investors who are used to seeing ETFs yield 3, 4, maybe 8%, MSTY looks almost unreal. But that's the power of turning volatility into income. Now let's talk about performance. Since launching in early 2024, MSTY has been more than just a yield machine. Its total return when you combine price action with all those distributions has nearly tripled, fueled by MSTR's momentum during Bitcoin's surge in 2025. Even though the covered call strategy naturally caps upside, MSTY has still managed to outperform most traditional dividend ETFs and deliver serious gains to early investors. But here's the catch, and it's important. Those huge yields don't come from company profits. They come from selling options. So, if volatility in MicroStrategy stock dries up, the yield could shrink. And because the strategy limits upside, you won't capture all of MSTR's explosive rallies if Bitcoin keeps running. That makes MSTY a high-income, high-risk, capped upside ETF perfect for investors chasing cash flow, but not necessarily for those who want maximum growth. Still, for income hunters, MSTY has proven itself to be a paycheck powerhouse. Monthly distributions north of 100% annualized are almost unheard of, and that's why it's been at the top of so many dividend watch lists in 2025. If you're comfortable with volatility and you like the idea of steady, oversized payouts, MSTY deserves a spot on your radar. Second on the list is ULTY, one of the more controversial names in the weekly and monthly dividend ETF space. This fund was designed with one goal in mind: deliver massive option-based income by writing covered calls on some of the market's most volatile and in-demand stocks. Like MSTY, it doesn't rely on traditional dividends. Instead, it thrives on volatility, harvesting premium income from options contracts and passing it straight back to shareholders as distributions. At its peak, ULTY was delivering yields north of 70% annually, with consistent weekly payouts that caught the attention of income investors everywhere. For those looking for a paycheck ETF, ULTY seemed like a dream come true. Its distributions have often ranked among the highest in the entire YieldMax lineup, making it one of the go-to funds for aggressive dividend investors. Performance-wise, ULTY has been a mixed bag. While the distributions have been undeniably huge, the underlying share price has been under pressure, leaving some investors worried about NAV erosion where the price of your investment slowly grinds lower, even as you collect income. This is the trade-off with high-yield option income strategies. You're swapping some potential long-term growth and stability for the immediate gratification of large payouts. The good news? ULTY has still managed to deliver positive total returns for investors who reinvested dividends, showing that the income stream more than offsets the price weakness. But for those who prefer to collect cash and not reinvest, the falling share price has been a source of frustration. That's why ULTY has become a hotly debated ETF. Some see it as one of the best high-yield income plays on the market, while others worry about its sustainability. What sets ULTY apart, however, is its broad coverage and ultra-high yield profile. Unlike single-stock covered call ETFs that only target one company, ULTY diversifies its strategy across multiple volatile names, giving it a wider income base. And for investors who can tolerate the volatility, it remains one of the heaviest weekly payers out there. In short, ULTY isn't for the faint of heart. It's best suited for aggressive income investors who want to maximize cash flow and don't mind the roller coaster ride in price. If you're looking for safer, more stable income, ULTY may feel too risky. But if your goal is to squeeze out the highest possible yield from option income, this fund still deserves a place on your dividend radar. Our third pick is a classic SCHD, the Schwab U.S. Dividend Equity ETF. And for good reason, it's one of the most respected and widely trusted dividend funds on the market today. While MSTY and ULTY grab headlines with their sky-high option-based yields, SCHD sits on the opposite end of the spectrum, representing stability, consistency, and long-term compounding power. Think of it as the bedrock of a dividend portfolio, the fund you can hold for years, even decades, without losing sleep. What makes SCHD stand out is its laser focus on quality dividend-paying U.S. companies. It tracks the Dow Jones U.S. Dividend 100 Index, which screens for businesses with strong balance sheets, healthy cash flows, and a history of not just paying, but growing their dividends year after year. Inside SCHD, you'll find some of America's most reliable blue chips names, like PepsiCo, Verizon, Texas Instruments, and Coca-Cola. These are companies that investors across generations have trusted, and SCHD lets you own them all in a single low-cost fund. Now, the dividend yield here is more modest, currently around 3.5% annually. That might not sound flashy compared to MSTY's triple-digit yield or ULTY's monster payouts, but here's the kicker. Over the past decade, SCHD has quietly delivered double-digit total returns thanks to the power of compounding. Reinvest those dividends, and SCHD becomes a growth and income machine that steadily builds wealth while also paying you along the way. Then there's the expense ratio, just 0.06%. That's nearly free compared to the near 1% fees you'll pay with higher-octane ETFs like MSTY or ULTY. For long-term investors, low costs make a huge difference because it means more of your money stays invested, working for you, instead of going to management fees. Over years or decades, that efficiency compounds into serious extra returns. And here's something dividend investors love. SCHD has consistently raised its annual dividend every year since its launch in 2011. That's 14 years of dividend growth and counting. This is a key difference between SCHD and many newer high-yield ETFs with SCHD. You're not just collecting a paycheck today, you're building a rising income stream for the future. That makes it a perfect fit for retirement accounts or anyone planning to live off dividends down the line. So out of MSTY, ULTY, and SLTY, which one stands out as the biggest game changer for weekly dividends? While each ETF has its strengths, my standout pick has to be MSTY. Why? Because it has proven itself as one of the most consistent paycheck machines in the option income ETF space. With a jaw-dropping 169% annualized yield over the past year and total returns boosted by Bitcoin's momentum, MSTY has delivered both cash flow and growth in a way that few funds can match. Yes, the covered call strategy caps upside and volatility risk is always in play, but MSTY is the fund that investors point to when they talk about turning market chaos into steady income. If you're chasing high-frequency payouts and want an ETF that's already building a reputation as one of the strongest yield max offerings, MSTY deserves that top spot. Now it's your turn. Which of these three ETFs do you think is the best bet for higher weekly dividends? Are you going all in on the consistency of MSTY, chasing the ultra yield of ULTY, or betting on crypto exposure with SLTY? Drop your thoughts in the comments below.